Hello and welcome back to Be Rich podcast. I'm here, Vinod, here to talk about three important things today. One, first, I want to touch upon three articles which I read, what's happening in the world in terms of the US market and world news. First one is about the de-dollarization challenges ahead, is what this article was discussing. It was there in CNBC. It talked about the US, the BRICS group which met, and about an Indian minister, which I don't want to really name whom he was, but him saying the problems they're facing in de-dollarization. He says de-dollarization remains a distant goal. He said he acknowledges the transition moving away from dollar, especially in international oil markets where the dollar's dominance, he says, does persist. That's why it's called the petrodollar. He claims to have made some strides, that the BRICS have made some strides in de-dollarization, but the challenges and the endeavor still remains large and looming. I don't know, it sounded more like a spin, that they really could not agree on anything, the meeting where these guys met. And even the African countries which were brought into or being offered membership into BRICS seemed a little skeptical about de-dollarization or even BRICS to start with. And the special economic zone which they were talking about. The Africans have always had a long history of being oppressed and being tricked and used. So they're very wary of when someone from outside Africa comes and tells them how to do things in Africa. So it's understandable. But anyway, this is an interesting article for all you guys who have always been wondering about this de-dollarization. De-dollarization, is it imminent? Is it going to happen? Is it BRICS are going to meet? BRICS are going to do this? From whatever the last meeting of the BRICS happened, it doesn't look like anything's going to much come out of it as of now. And the dollar is very much here to stay, at least for the foreseeable future, is what I was trying to say. The second article I read about was what Powell said in Jackson Hole meeting and the market's reaction to that. And Jeremy Powell did not mention anything in the symposium that the inflation is down and the economic growth is high, but the market took his remarks as indicating that things are really good, that the markets are doing better than what he expected, that is a positive response, and the market is flying with it, thinking that interest rates are not going to go up. But this is despite Powell's caution about the raising interest rates. The market is cheering about the optimistic outlook he has given. And his words are open to interpretation. It's left a lot of room on the floor to look either way. If you're a bear person, you can say he's not being positive, and if you're a bull person, he's not being negative. You can really take this. But the US market did dip initially and has rebounded significantly since that, especially the Nasdaq composite has also moved up. The third article which I read, which was rather interesting, was about the gold's movement and the Fed's influence on it. It explores how gold prices are dipping and rising based on the US inflation data and the weaker job numbers, and the view that the federal government will keep the interest rates at the current levels. Gold settled down for the month, making it the third negative month out of the last four. The report did mention, while the economic numbers are not particularly strong, that they are not dismal either. So it's not good, not bad, somewhere in the middle, mediocre at best. This uncertainty is what's leading to a lot of speculation, and the Fed might pause their interest rate hikes earlier than expected. And it also touched upon the US Treasury yields and the dollar fluctuations on gold prices. This is summary of these three articles. I thought it's nice that the de-dollarization is still a distant goal. It's anywhere close to even having something on the drawing board. And though Jeremy Powell's been trying to walk a tight line, the market seems to be putting words into his mouth and reacting to it even before things are being said. So these are the things which I wanted to actually touch upon before we get into the main topic today, which is about another book called The Aggressive Conservative Investor by Martin J. Whitman and Martin Shubik. This was written way back in 1979, I think. This is one of the early, value investing books. So what makes this book special? Well, this book unveils this whole contrarian mindset. Imagine in a world where you're investing and it's just not about following the crowd, but rather about challenging and the conventional wisdom. In their book, Whitman and Shubik introduced this concept called aggressive conservative investor. What is it all about? Well, it's marrying the wisdom of conservative investing with being audacious and going against the grain, meaning going against the crowd. While you hold on to the principles of value investing, but at the same time, you don't follow what everyone's doing. They, they encourage you to embrace this contrarian mindset, which means to think differently, to think in the opposite direction, and seek out hidden gems, right? Others might be overlooking. And it's interesting kind of analogy to Indian market, because this book was written way back in the 70s, and the American landscape, financial landscape, was very different, vastly different from what it is today, because we have a lot of technology and things happening in America, and America is really globally wired into the global economy, while India is very nascent and we're still not really in the global market as big as America is or China is. We're still making headways, and our stock market is still in its infancy compared to America. So if you look at it in that terms, there are a lot of hidden gems in the Indian market, and the Indian stock market is like the America's Wild West from the 1900s or even earlier, from the 1700s and 1800s. It's like the Wild West, where there's lots of crazy deals happening and a lot of movement. We did even see in the news about Adani and the way they're manipulating the shares. I don't want to get political about it, but you do see it, that there are people who are taking strange routes into making their companies profitable, is least to be said. But in this landscape, there are opportunities to find those rare gems if we keep our conservative mindset in place. So that's what's important. He's saying it's marrying both, marrying being a conservative wisdom and believing in value investing, believing in honest, straightforward promoters and balance sheets. At the same time, going against the grain, just not doing the Tatas and the Reliance and trying to see what else is there beyond that to see. But do realize, this is where this second part of this segment is very important in this book. The heart of the philosophy lies the concept of value investing, importing the meticulous research and analysis to uncover assets that are below trading their intrinsic value. All of you keep asking me this repeatedly: what is this intrinsic value? What is this intrinsic value? How do you calculate intrinsic value? Well, it's very difficult to calculate intrinsic value in terms of numbers. I would say it's more like, yes, you can say cash reserves are this is what's there in the balance sheet. But after this episode of Brightcom, we realize now that you just cannot rely on whatever the balance sheet is said, or even what the bank statements is saying, because all this can be fabricated. In India, our systems are so wonky that things do fall through the cracks. So you really can't rely on calculating intrinsic value based on just on company data. You do have to do meticulous research on the person running it and uncover any analysis or whatever assets these guys have by actually finding out more research you need to do. You just can't calculate the intrinsic value on the information in the balance sheet. Yes, the balance sheet and the financial reports are very important. You should read them, and you can't take a few bad apples and say write off the entire market. I do agree on that. But to calculate this intrinsic value, you have to, in India especially, it's more like a gut feel. The more you read about it, the more you research, you start getting a feeling, this is right. It looks like a good company, looks like a right thing. Especially when you keep your core philosophy being conservative, that you're not trying to make a quick buck. You're trying to hold on to this as an investment, as an investor. You're buying into the business for a long haul. If you keep these numbers and these things in mind, then you can get into this intrinsic value, which we used to you as a value investor. The problem is the human mind is very finicky and will tend to sway very easily as we start getting biases, like what Charlie Munger said in that book which he recommended, Persuasion, where you get into this feedback loop where you want to see the information you want to see. You start seeing the numbers which you like. You ignore the things you don't want because you're so keen on finding this hidden gem that you start believing every single coal is a diamond. Yes, every single coal has potential of becoming a diamond, but unless it's been put under the pressure for several years and kept in that kind of situation, it doesn't turn into diamonds. Coming back to the book, so the undervalued opportunities can stem from various sources, they say, from market misunderstanding, corporate restructurings, or even financial distress. And there have been many stories, we have spoken about this in great length, like how Warren Buffett has used this from market misunderstandings, like the Great American Express story. If you guys know about Warren Buffett, how he picked American Express as a company to invest into, corporate restructuring, that's how Berkshire Hathaway came about, if you read about that. And financial distress, this happened all over 2008 when a lot of companies were under enormous financial stress, and Warren Buffett was sitting in a lot of cash, and he was ready to help them all out. In return, he could buy sweet businesses at very cheap prices. That's one of the main motivations. He's sitting on so much of cash right now because he thinks there is an opportunity which is going to come, a big opportunity, once in a lifetime kind of opportunity is going to come, and he wants to have a lot of cash in his hand to go shopping at that point in time. So by spotting these opportunities, and investors can potentially capitalize on market inefficiencies and can get impressive returns, is what they say. The third part of the book is about balancing aggressiveness with being prudent. So while the term aggressive might evoke notions of risk taking, the authors constantly remind us to be prudent. Prudence is as important as being aggressive. It's a crucial aspect to this approach. It's anyone who's studied any form of for any form of combat, be it jiu-jitsu, judo, or karate, or if you've done MMA training, you do realize it is important to be aggressive, but at the same time to be prudent and study your opponent before you decide to attack them or get defensive. So it is important to pay attention to what's happening in any situation and just not go all out with your emotions. They advocate for maintaining a margin of safety and diversifying your portfolio to mitigate risk, because risk is always there. And yes, it is a delicate balance between taking calculated risks and safeguarding one's investment, a lesson that resonates even today in our market dynamics which we are going through. Then they talk about the psychological landscape of investing. Beyond numbers and charts, the aggressive conservative investor talks about psychological aspects of investing. The authors shed light on how market psychology and behavioral biases can influence our decisions. And by understanding these psychological factors, we as investors can make better decisions and avoid these emotional roller coasters of the market and make rational choices. And applying these principles, they assure you that you can see very good returns in any market in any point of time. If you remain, the essence of the book remains relevant even today. Whether you're an individual investor or a professional managing someone else's money, seeking out undervalued opportunities and maintaining it in a conservative yet daring approach, you can take master the art of risk management, is what the key takeaway of this book is. So this is a book which I do recommend you read. It's not one which is often recommended. It's not the popular ones. It's not the intelligent investors. It's not George Soros's book or anybody which we usually talk about. The aggressive conservative investor is a different book. And since the reason why I brought up this book was because a lot of you keep asking me repeatedly, should I sell this? Should I hold on to this? And it's very hard to tell you what to do with your money, because it is completely a self-driven process. I know all of you want answers. So it's important to keep all this in mind and remain vigilant about your emotions. At the same time, be aggressive, and you can definitely make a good profit. And the reason why I was saying it, as I got a call and I got digressed, was a lot of you keep asking me if I should hold on to this share or sell this share. What should I do with my portfolio? There are no answers to this, because simple reason, you have to do the work. And it's an individual thing. What amount of capacity of risk you have, appetite for risk you have, how much loss can you suffer? And we have been riding this bull market for such a long time. All of you just assume this market is going to do good and it's going to just keep going up. Anand said this, and I bought this, and now it's gone up by 3%, and last month from then it's gone up 5%, and you're feeling very happy. But please do realize when the market does correct, and it does sometimes tank and it bottoms, it's a rock bottom, all your portfolios will suffer losses of 10, 15, even 20%. You can really, if the market is down 40%, your portfolio, even if you've been a very smart investor, can be down 20%. And you have the stomach to bear this kind of thing is what the key thing is to remember. Even though, let's say, you bought a company for 10 rupees and now it's trading at 1000 rupees, you're feeling great because in your mind you think you have 1000 rupees in your account. And the minute that 1000 rupees corrects, let's say, to 500 rupees, you feel like you've lost 500 rupees, though you have not. Because you only put 10 rupees and that's still gone up at 500 rupees, but you can't see that. That loss which you will feel from 1000 to 500 will be critical on you staying in the market. So I want you guys to keep this in mind because a lot of you keep messaging me on Instagram saying how happy you are that you followed this and now your portfolio has gone up by X, Y, Z percent. Yeah, I'm happy for you too, but do realize this in the long term, yes, is great. There are short-term market movements where you will feel the pain and you should be ready for these moments when the pain happens. You need to mentally fortify yourself and let's not be exuberant that you are performing well and you're beating the market or whatever you're telling yourself right now. I do want you yourself to be, like this book says, conservative at the same time aggressive with your investing and your psychological outlook, because otherwise you will find it very hard to stay in this market. That being said, a lot of you have been asking what are these different instruments, investment instruments which are available as investors. Are stocks are the only options, are bonds the only options? So I thought I'd broadly talk about the four classes of investments which are there for us in India right now. One is stocks, equities, which is owning a piece of a company, which we all know about, which is where mutual funds are, and it can be volatile. At the same time, you can get very good returns and high growth if you buy at the right price, if you buy the companies at the right price. Second, which is there in India, is bonds. In India, you have government bonds and corporate bonds. And they provide stable income through interest payment and offer to principal repayment at maturity like an FD. This can offer stability to your portfolio. So if you are in the stock market and you feel like you need to hedge yourself so that even the market does turn bad, you don't feel so bad, you can keep a certain portion depending on a risk appetite in bonds and the length of your runway. Anand said this many times. So taking into various factors into account, you can decide to hedge yourself and keep some of your investment in bonds. Then we have the mutual funds and ETFs. What are the difference between a mutual fund and an ETF? Mutual funds are bought and sold once a day after market hours and the prices are fixed like that. ETFs are the same things as mutual funds, which are units of a bunch of stocks which are put together and sold as units, and they traded throughout the day. And the price of the mutual fund and ETF are based on, one, the underlying assets which these mutual funds hold, the company stocks they're invested in, and the second is the mutual funds and ETFs independently can trade on their own price points. If the market believes these ETFs are really valuable or mutual funds are really valuable, then they go up, their points go up. Otherwise, if someone thinks their fund manager is not really reliable or trustworthy, the same mutual funds, though their underlying values, stocks can be good, maybe not traded very well. So this is something to remember when you talk about mutual funds and ETFs. Then the fourth class of product for investment in India we have is real estate. Problem in real estate right now is the Indian real estate market is overpriced. It's extremely on the higher side and there are no real opportunities. And lots of you who are interested in buying real estate, being from middle class families, cannot afford these prices and you tend to take loans. And the current environment is not conducive to take loans. You should not be taking a loan to buy anything right now because there's no guarantee about your jobs, there's no guarantee on anything, and because the situations are so volatile and things are changing quite dramatically from month to month, you should try and not burden yourself with a loan. In case you take on a loan and you're not able to make the payment, that loss is also terrible and it does psychological damage more to you than anything else. Majority of the people who suffer mental anguish and psychological anguish, believe it or not, 80% of people taking their own lives or going dramatically, taking the extreme action, 80% of it is because of money related and what will people think of me related than anything else. believe it or not. So this is why I say don't try and take loans unless you have no option. I would say don't buy it. That would be my advice. Of course, the fifth one is gold. I don't consider gold as an investment. It's more like a something you can rely on as a backup to keep, in case the worst of the worst happens, you have something to hold in your hand and take and go. Gold is just that security it gives you. So I won't class it as an investment product by itself because it really doesn't offer returns of any sort compared to the others. So these are the investment instruments which we have in India, which you can look at. And I've given you broad characters and elements in each one, so you can understand what it's extremely basic what I've said. And you can move your money through these different cycles. Each one runs on its own individual cycle. So by moving your money and funds from one to another and riding different cycles, you can definitely make very handsome returns. No matter how long your runway is or short your runway is, you can make returns. But do realize this is on your individual basis. You have to see and study and see your own risk appetite and what you're ready to do and the kind of losses you're willing to swallow. Based on that, you can enter each one and make some returns. That being said, thanks for joining me today on Be Rich Podcast. I hope you found this informative and entertaining as always. And I did read the feedback about all the comments on the video yesterday. Unfortunately, the studio was occupied at the time for an interview and we had no option but to hoist the camera inside the editing room and try to do our best and get a video out to you guys. Shashwat was not available and Anand was terribly busy yesterday with the whole series of interviews. So I had to do this on-spot quick video to you guys about CAS. Some of you did understand what I was trying to get at. Some of you felt that I was meandering a little bit, which I did. I do agree. Could have done a better job of it. But the essence of it is, the second half of the video especially, when I talk about the examples, is that if you see we are in a very close to a situation where globally and domestically our markets are really stretched and we're in a very, very big bubble. And when this bubble is going to burst, I have no clue. But when it does, I don't want you guys to get burnt. So I just want you to be cautious in all your endeavors in investing. Anyway, thank you today for joining me on Be Rich. Do subscribe and turn on the bell notification as always. And I'll see you on the next one. Bye.